Hi, everybody. This is Alan Ellman, the blue collar investor, with today's option selling question of the day. Today's question comes from Phil. Alan, in bull markets, isn't it a good idea to buy stocks, wait for appreciation, and then sell the covered call? This way, we could take advantage of market conditions. Thanks, and it's signed Phil. Okay, this question does come up from time to time. And so I thought it would be a good opportunity now for me to address it to the entire BCI community. All right, so given the scenario of a bull market, let's have a look at some of the guidelines that we could use to enhance our covered call writing trades. One of the things that's important in a bull market is to consider using deeper out-of-the-money call options. In other words, higher out than the current market value. What this does, it gives us an opportunity to still collect our option premium. Of course, it'll be a little bit less than had we gone closer to the money. We're going further out of the money, so we're going to get a lesser premium, but we're also going to have greater opportunity for share appreciation from current market value up to the higher strike price. So that's one of the things we could do in a bull market environment. Now we can also change the range of our initial time value return goal for the monthly contract. Same thing would apply if we were using weekly contracts. Now, I've been pretty clear over the years that in my portfolio, my initial time value goal range is 2 to 4% a month in normal market conditions. I dropped to 1 to 2% a month in my mom's more conservative account. Now, I've also written quite a bit over the years that in a bull market, I'm willing to go as high as 6%. Since the market conditions are moving share price up in general, we could take a little bit more risk to the upside. So I'll change that range from 2 to 4% up to 2 to 6%. So using slightly more risky stocks, those with higher implied volatility, is another thing we can do in a strong bull market environment. The third thing we could do is to be prepared with our bull market exit strategies, like, for example, the mid-contract unwind exit strategy. This is a scenario where the stock price moves higher and higher, leaving the strike price deeper and deeper in the money. When this occurs, the time value component of the premium will be approaching zero. We close our entire position, short call and long stock, and we use the cash to enter another position in the same contract with the same cash investment. So being prepared with bull market exit strategies is the third thing that we could do. So let's have a look at some guidelines that will help us assist our covered call trades, given Phil's question regarding a bull market and how we should manage these trades. So let's start off with something that I feel very strongly about, and something that, if you turn on the TV or read a newsletter, you'll be hearing the opposite. But I believe that there is nobody out there that can time the market consistently to be always right about the market direction. It's just way too complicated of a global economy. We're on a 24-hour news cycle where so many things could rock the market. Now, of course, the basic fundamentals is what's most important, but in the short run, nobody can predict what's going to happen with a particular stock or even with the entire market. We could certainly do things that throw the odds dramatically in our favor, and that's what we do as we master the 3 required skills: stock selection, option selection, and position management. But buying a stock and feeling almost 100% sure that it's going to accelerate in the short term so that we could then sell the covered call and end up with an even better return is something that's adding another layer of risk to what is a very conservative option selling strategy. So our covered call trade should be executed when the elite performing stocks are bought and options are sold that meet our initial time value return goals. That's it. We select a stock that meets our system criteria. We look for options that meet our goals. If there are, that stock is in. and becomes part of our portfolio for that contract month. If we break it up, as I said, we're adding another layer of risk. And covered call writers basically are conservative investors with capital preservation in mind. And so adding another layer of risk is something generally most of us don't want to do. And we should base our trades on current information. That's what we have today. That's why we said, well, we have a bullish assessment of this particular security. And this particular option does meet my initial time value return goal. And therefore, based on current information, we're going to select that particular covered call trade. Now, we can say we love the stock now, and we're going to love it even more in a week or two. And therefore, I'm going to wait to sell a different option in a week or two, because that's not based on current information. That's based on hypothetical information. And as I said, adding more risk to our trades. Now, when I got this question from Phil, it reminded me of an email that I received from Joanna back in August of 2018. And that email basically showed that 3 of the securities that she had in her portfolio had declined in value despite the market accelerating. And she was very concerned about that. So let me show you a comparison chart of those 3 securities, which you see the drop in those 3 securities, which are HDS, CPRT, and HQY. And the yellow field shows the decline in price in August of 2018. And then where you see the green arrow, you could see the S&P 500 was moving up. Who would have known? None of us, really, because these were elite performers. But in the short run, something brought them down. And so had we bought the stock and then not sold the option, there would have been lost opportunities that I want to show you right now. Okay, let's start with CPRT, Copart Inc. And if you look to the top right part of the screenshot, you will see the decline in August of the share price, and then the acceleration of the share price in the shortly thereafter. Now you see a classic V-shaped pattern. Does that remind you of any of our strategies? Absolutely right. We hit a double. So that's where we sell an option on an accelerating stock, and then the price goes down, and we buy back that option at a lower price, meeting our 20%, 10% guidelines. And then if the price goes up in value, we could resell that same option. You see that classic V-shaped pattern. Want to see another one? Here you go. HDS, same exact thing. Now, had we bought the stock, not sold the option and waited, and then when it went down, had we sold the option at that time, we would have locked ourselves into a loss, a share loss. Now, had we not done anything and waited for the stock price to rebound, then we would have got back most of the share loss, but by that time, the option premium would have been dramatically less. And just for the fun of it, let's see a third one, HQY. You see that dropped even more dramatically than the other 2 securities and rebounded very, very strongly thereafter. All of these were opportunities to hit a double. Had we not done the stock purchase and option sale simultaneously, these all would have been exit strategy opportunities lost. So I'm sure that we could find examples where the stock price went up after the shares were purchased, and that particular strategy would have benefited. Absolutely. But the point is, do we want to take a conservative strategy and add more risk to it? I say no. That's my vote. Now, for those of you that have a higher risk tolerance than I have, that approach may be appropriate. So you have to know yourself, and how important is capital preservation? Are you willing to incur additional risk? But if you are, is covered call writing really the right strategy for you? So this is just some food for thought. I'm certainly not telling you what to do. I have too much respect for our BCI community for me to do that, but I'm just sharing with you some of my thoughts. And that can either be used or just thrown away. But here are 3 great examples where we have lost opportunities had we not done these trades simultaneously, the stock and option positions. All right, let's review. When initiating a new covered call trade, we buy the stock and sell the option simultaneously. That is because we are basing our information on what we currently know. We know that the option premium meets our initial time value return goals. And what's going to be with the price of the stock a week or 2 or 3 down the road, that is information we don't have and we don't know. Consistently timing the market is impossible in my humble opinion. Now, I know there are going to be people that tell you that they could do it. They have these formulas, these algorithms, they're right all the time. I have never seen it yet. So we have to certainly throw the odds dramatically in our favor and also be prepared with our exit strategy arsenal. But we don't know what's going to happen in the near term with the market and certainly not with an individual security. By mastering the 3 required skills, stock selection, option selection, and position management, we absolutely can throw the odds in our favor. But nothing, ladies and gentlemen, is 100%. Except for this. I want to thank Phil for sending me that question. It's a very important question. And I guess indirectly, Joanna, for sending me her trades several months prior to Phil's question. It turned out to be very valuable information for this particular video. Finally, I want to remind all of our premium members that only premium members have access to our entire library of Ask Alan videos, now 163. We add a new one every month. On the right side of the member site, you have a file for Ask Alan videos with all the titles. So you may want to reference those and see which ones you want to see for any particular need that you may have. It's something we've been doing now for almost a decade, and we plan on doing moving forward, and I have no plan on stopping adding our Ask Alan videos. I have too much fun with it, and I feel that it provides some very useful information to our BCI community. So thank you, Phil and Joanna, and thanks to everybody out there for taking the time to watch this video. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.